Hello, this is Matt Clarkin, and this is a CHSA update for September 30th, 2020. So this CHSA update is part 2 regarding this issue of qualified HSA funding distributions or transfers from an IRA to an HSA. So just a real quick review of what we went through last time. You must be HSA eligible to make this transfer. It's one per lifetime. The IRS allows one per lifetime. It's from a traditional IRA or a Roth IRA that you can make these transfers. The transfer does count against the annual maximum. So whatever the maximum contribution for the HSA is, that's the maximum amount you could move from the IRA to the HSA. Transfers relate to the year in which the distribution is made. And finally, there's a 12-month testing period from the time in which that transfer is made where the individual has to remain HSA eligible or they face tax plus a penalty on the amount that they transferred from the IRA to the HSA. So looking at the pros and cons of moving money from an IRA to an HSA, this is looking at a traditional IRA to an HSA. When you look at a Roth IRA, there's really virtually no good reasons to make this transfer. So we're looking at the traditional IRA to an HSA. First, tax-free distributions. That HSA for a qualified medical expense, no tax on that, which is not obviously the case with the traditional IRA where that money would be taxed. Required minimum distributions do not exist with that HSA where they do with the IRA, so another advantage of having that money in the health savings account. Earlier access to the money in the IRA is an advantage over the health savings account between 59 and 59.5 and 65, where if you take money out of the HSA prior to age 65 for a non-qualified medical expense, you are paying tax plus that 20% penalty. So that's an advantage of having that money in the IRA. Now at age 65, it's a wash. At age 65, if you take the money out of the HSA for a non-qualified medical expense, it's going to be taxed just as it would be with the IRA. And finally, when it comes to distributions, because the HSA, if you're taking it out for a qualified medical expense, is not taxable, it does not count against one's modified adjusted gross income. And if you recall through the CHSA program, when we talk about IRMA surcharges on Medicare Part B and D, how much you pay actually for Medicare, it's based on one's modified adjusted gross income. So this actually could save someone from paying extra for Medicare Part B and D. A couple final notes on this issue. HSA owners with current or anticipated medical expenses and no other source of funds for an HSA contribution other than that IRA may look to the IRA to move that money into the health savings account. Now, really what they're doing is they're trading one tax favored account for another, and essentially they're using a long-term asset to pay for current expenses. So in this case, people need to realize that while they're taking advantage of the current advantages available with that HSA, they are foregoing the long-term advantages of building up money for retirement, which they had with that IRA and could have with the health savings account if they left it there and built it up over time. So again, there needs to be a lot of communication with regards to the pros and cons of someone actually taking money from an IRA to an HSA, especially if they're really looking just to pay today's expenses. So again, this question came up, and this is the reason we've done this couple CHSA updates regarding IRA transfers. If you have any questions concerning this or any suggestions for future updates, please let us know at info@accesspointhsa.com. Thank you.